Hey folks, Dan Bird here on Wednesday, the 24th, doing a technical Tuesday. Yes, on a Wednesday. Didn't have a chance to do it yesterday, so I promised that I would get to it today. I'm going to talk about the options wheel strategy. And quite frankly, there are lots of YouTube videos out there about the wheel strategy, so you can certainly get into a lot more detail probably than what I'm going to cover. But I'm going to give you the basics, give you an overview of what it is, and also talk a little bit about how to use a portion of this to buy a stock that you might like to get into. So let's get started. As always, I am not a financial advisor, so this is for educational purposes only. And before I get started, let's go take a look at what the market did today. Look at the S&P. I said that it probably would continue to go down, and it did. Pull back a little bit right at the end of the day, but continuing to go down, sitting right on the 8-day moving average right now. All of the overbought indicators are just starting to move lower, so that's a lot of times might imply that we're going to get a bigger pullback, but could also just go sideways like it does here. As long as the RSI stays above 40, which is this pink line right here, then it's still bullish, still on a bullish trend. And the pink mountains you see right here is money flow. So again, if that stays above this 40 line, then that's all still very bullish. So it could be just a very slight pullback. We'll see. Gamma flip line is right down here. If it goes below that, which is below the 21, then all of those are indicators that perhaps we're going to have a bigger sell-off. But we're not there yet. And so we'll just continue to watch these. We'll see how they do the rest of the week and just go from there. NASDAQ 100, same thing. Looks the same, almost identical. The Russell 2000, actually sitting right on the 8-day. It's actually below the gamma flip line. Interesting. This was not like this earlier today. So it now is below, so that's a negative gamma. So that means that market makers, instead of buying the dips and selling the rallies, they will sell the dips and buy the rallies. So we don't know yet which way this is going to go. If this reverses tomorrow and starts to move higher, that could imply that market makers will not sell the rallies. So they're just going to let it continue to go higher, maybe all the way up here to the expected move of 255. But if it continues to go down tomorrow, then that implies we could get a much bigger sell-off as a result. So this is going to be really interesting since I just started learning about this and putting it on the charts. This is the first time I've actually seen it now drop below into negative gamma. So I want to watch and see what kind of reaction it actually has. So we'll keep an eye on that as we go along, and I'll look at that each day, actually. Here's the Bitcoin, pretty much like it was earlier today, sitting right on an important support line, bounced off of that, actually went right back up to the moving averages, and now it's sitting right in between the two. So this one is important for Bitcoin. So the rest of the week is going to be pretty key. All right, so let me go now, take a look. Let's talk about what we're here to talk about, and that is the wheel strategy. So I put these slides together to try to explain what the wheel is. It uses options. And actually, before I do this, let me go back to the website, to the options page on the website for subscribers. And first thing I want to point out is this over here, both time decay and whether options are bullish or bearish. And if you click on that, you get a bigger view. So you can see as a seller, that's what we are going to be doing. We will be selling options. We will not be buying options. So as a seller, if you're selling calls, that is a bearish position. If you are selling puts, that is a bullish position. That's intuitively the opposite of how you normally think about options. Usually you're buying calls, which is bullish, or you're buying puts, which is bearish. But we're not buying, we are selling. So we are now, think of yourself as the house. So when you're selling, you want 30 to 45 days out to take advantage of time decay. So here's time decay down here. You can see time decay as you move along rapidly decelerates. So if you're a buyer, that means you're losing valuable value in your options because time decay is working against you as a buyer. especially in this last 30 to 45 days right in here. So as a buyer, you want to be buying options out here 90 to 120 days. Let time be your friend. Buy it as far out as you can. But as a seller, you want to get it earlier. So that's what we're going to be doing. We're going to be looking at this area right here from 0 to 45 days. So always keep that in mind when you're dealing with options. And again, you can just come to the web page on the options page to look at that chart and understand it a little bit better. It's right there. Okay, so now that we know that, let's go back and start talking about this. So we're going to talk about the wheel strategy. It's designed to generate consistent income through options trading. In particular, selling of options. It consists of a cycle of selling put options, potentially acquiring the stock, and then selling covered calls on that stock. Again, in both cases, we are selling. Primary goal is to earn premiums from selling options while managing the risk of stock ownership. And I'll show you how all this works here in a second. It's pretty interesting. All right, here's how we're going to start options wheel strategy. There are two ways you can use this. One is just for share acquisition. So if you want to have a medium to long-term position and you want to get into a position at a cheaper price, this is one way you can do it. I'm going to show you how to use this in a different way just to simply generate income. But let's look at this one first because this is basically the standard wheel strategy. All right, so the goal is to buy a stock to hold at a discounted price, generate income while holding the stock. You're okay. These are important components right here. You're okay owning the stock. So you want it to be a stock that you like, one that you would be willing to hold anyway. I'm using Honeywell as the example because a subscriber asked me last week about Honeywell. I said that the chart didn't look that great. It continues to go down. And he said, I am buying it anyway. So he's a value investor. He's looking for strong companies that aren't going away. They're not going out of business. He's looking for when they have sold off quite a bit, trying to get it at a lower price. And he doesn't actually care if it goes down some more. In fact, he said, I'm going to put 25% of my portfolio in, and if it goes down some more, then I'll buy another 25%. And he'll continue to do that until he's fully loaded, and then hopefully hoping that the stock will turn around and start to go higher. This will show you a way that you can do the same thing, but get the stock at a lower price, at a discount. So number one, you're okay owning the stock. It's something that you're already interested in. You don't want a stock that's too volatile. You want something that trades pretty quietly, up or down, sideways, something like that, but usually not the big tech names, certainly not the quantum names, things that move around a lot. You don't want stocks like that. You want a stock that's pretty steady. You want something that the trend is generally higher or sideways. You want the market to be bullish in general, so the overall market should be bullish. You're willing to buy more if it falls moderately. So just like I was saying, you could buy a portion, 25%, 30%, 50%, something like that, and you're willing to buy more if it falls. And then once the stock is owned, meaning you'll see how it's owned over here. I'll do that in a second. You may or may not then use covered calls to generate more income. Now, if you just want to own the stock, this is a way of buying it cheaper than what you normally would. You don't need to do the covered call portion. But if you do want to try the covered call, which I'll show you here, then you can generate even more income. All right, so that's basically the idea. That's what we're trying to do. So let's start here with a cash secured put. So this is the starting point for this whole wheel strategy. You don't own anything yet. You don't own any stock. So you're buying a put, or I'm sorry, you're selling a put, and you have enough cash in your account that if this stock ends up being assigned to you by the expiration date, you have enough money to be able to buy it. So it's a stock you were going to buy anyway. So that obviously should be the case. All right, so let's take a look. Cash secured put, you sell a put option and simultaneously set aside enough cash to buy the underlying stock if it is assigned to you. Strategy allows you to generate income from the premium while either buying the stock at your desired lower price or just keep the premium if the stock stays above the strike price. So think of it as putting a floor underneath the price. So you can generate income, You receive the premium upfront that goes into your account right away. Buy at a discount. If you are assigned, you end up buying the stock for less than what you would have bought it just on the open market because you've got the premium also. And lower cost. So the premium then lowers your cost basis on the stock. What are the risks? Well, you're obliged to buy it. So if you are assigned, meaning that the stock is selling for less than what you sold your put for, less than the strike price, then you are obliged to buy it. But you were going to buy it anyway. So that's not really a big risk. Market risk, you're still exposed to the stock price declining. Well, you already knew that. You were going to buy it anyway, so you already know that risk. And then limited profit, your profit is limited to the premium received unless you are assigned the stock and the price goes up. So in this case, the premium is what you're gathering. All right, so let's take a look at an example. Here's Honeywell. This is a chart from today. Not sure where Honeywell ended the day, but this is from earlier today. It was hovering right around 209. So if you were willing to buy it around 209, like I think this particular person was right back around here last week. If you're willing to buy it at 209, instead of buying it outright, you could sell a put. So here are the puts on the right-hand side. All right, so the cash secured put puts a floor on the target price. If the stock trades above the strike, you keep the premium. If it trades below at expiration, you're assigned the stock and you now own it. So let's see how this would play out. So in this case, right here, stock is at 209. We're looking at the 210 strike price. And if you were to sell a put at 210, you would make $2.80. So $2, and the expiration in this case is 9 days away. So you see October 3rd, it's a week from Friday. So it's only 9 days away. Remember, we want something close in to let the time decay work in our favor because we want it to expire worthless, or we want to be assigned. So you sell it at 210, you make $2.80. One contract is 100 shares, so 100 times 280 is $280, goes right into your account. More importantly, if the stock is below 210, then you are assigned the shares at a discounted price of 207.80. That's 210 minus the 280 premium. So instead of buying it at 209 outright in the market, you're now getting it at 207.80. If it's above 210, then it expires worthless, and you just simply keep the premium. You will not be assigned the stock, you just keep the premium. And then you can turn around and do it again. And you can keep on doing this over and over, making the premium, lowering your basis until you finally get assigned the stock. Once you are assigned the shares, you can then either sell covered calls and or, if the stock falls more, sell another put at a lower price, strike price. So you can do, so if you do 25% of your portfolio or whatever you're willing to spend on this, and you get assigned the first time, you can do it again. If you don't get assigned, you can do it again anyway. So even if you are assigned, you own that 25%, you want to go to your next 25%, do it again down here at a lower price, and you keep buying it at a discounted price. So hopefully you understand how cash secured puts work in this case. That's what it looks like on the option chain. Buy it as close to the current price as possible because you actually do want to be assigned. At some point, you want to own the stock. So you want to get it as close to there as possible. All right, let's go back and see what happens next. So now we've got a cash secured put out there. Is it assigned? Do you get assigned the stock at expiration? No, do it again. You just keep doing cash secured puts over and over again. Keep pocketing the premium, just like an insurance company insuring your house. And it continues to lower your basis once you do get assigned, or it just keeps putting money into your account. So, but what if you do get assigned? What if you do end up owning the stock? Now, the next step is the covered call. So now you own the stock. You've been assigned at expiration. You own the stock now. So now what does that mean? Covered call, it's a sale. Again, this is a sale of call options by a seller who owns the shares. That's what makes it covered. It means you own the shares. Seller is creating an additional stream of income. At worst, the investor would have to hand over the shares if the options are exercised. So kind of the other way, the opposite of the cash secured puts. In this case, you're putting a ceiling on the stock. So if the stock trades below your strike price, you just keep the shares and you keep the premium and do it again month after month. I'll show you an example. Covered call strategy is generally used when the seller intends to own the shares for the long term, but does not expect them to increase in value sharply before the option expires. That's important. That's why you don't want something that moves a lot. Pros, covered options limit the risk and potential downsides of an options contract. Option writers can earn a reliable premium from a small price increase. And by the way, I'll show you an example, whatever that strike price is, anything below that, and you keep the stock and the premium, anything below it. The cons, option writers must be able to produce 100 shares for each call option that expires in the money. Well, if you're doing covered calls, you already have the shares. So that's not an issue. If an investor is very bullish on a security, they can make more money from uncovered calls or buying the underlying security. So if you think this is a stock that's going to go up rapidly, then it makes more sense just to simply buy the stock. But if you think it's something that might continue to trend down in the short term or might turn around and slowly start to rise, then this is a great way to generate income. All right, let's look at an example again with Honeywell. In this case, we're back to the 209 level. Let's say we were assigned the stock at 210 minus the 280, so 207.20 is our basis for the stock. Now we own it. Remember back on that flow chart, we now own the stock. So what do we do next? We want to generate income. So in this case, we're going 30 days out because we make a better premium and it's safer. We can go all the way up to $220 instead of making it very close to where the price is. So let's say we get a sign down here at 209. Now we do our covered call at 220. Now remember, now we're putting a ceiling on the price. So as long as it stays below 220 for 30 days, then we will keep the $1.45 and we will keep the stock. And then we can just do it again, over and over again. So you see down here, here's the calls on the left-hand side. Here's 220, the strike price. And that's what you would be paid, $1.45 when you sell a call. So the idea here is continue to hold the stock for the long term, even buy more as it continues to go down, but generate income and lower your basis. That's the important thing. You continually lower your cost basis. So now if it went up there and actually exercised, if it actually did go over 220, you would have to sell it at 220. Plus you've already made the $1.45. So your profit is 221.45 minus the 207.20 that we bought it for with the cash secured put. So that's not a bad trade right there. But hopefully it's not going to go up that fast. So it's going to go in 30 days, somewhere underneath this. It'll expire worthless. You keep all of your shares and you keep the $1.45 and you just do it again. So you can do it over and over again. So you can do another cash secured put. So that's why it's called the wheel, because you can just go around in circles. It goes over and over again. So let's see how this plays out. So now in this case, we were assigned, now we own the stock. We do a covered call. Now, is the strike price greater than the strike at expiration? Well, no, if it's not, then you keep the shares and you do another covered call for another 30 days. And if you are making that 30 days out and the stock is not rapidly rising, then you can do this over and over and over again. Just keep collecting the premium and continue to hold the stock. As long as you can do it correctly and the stock doesn't accelerate too fast. Now, what if the stock price is lower at expiration? In that case, the stock is sold automatically, so it's called away, and now you go back to your CSP, cash secured put. You can do it on the same stock, or you can pick a different stock if you want to. But then you just start the whole process over again. So you're lowering your basis, you buy it again, you're buying it at a discount, you go through the same process. If it doesn't get assigned, you continue to generate premium up there. And if it does get assigned, oops, let's go back here. And if it does get assigned, then you just continue to do covered calls, or you don't have to do the covered calls. You can just hold the stock. At this point right here, when you get right to this point here, when it's assigned to you, you don't need to do the covered call. I mean, it's a good way to generate income and lower your cost basis, but you don't need to. You can just hold the stock, but now you bought it at a discount. You bought it at a lower price than you would have normally. All right. But that basically is the wheel strategy in a nutshell right there. Kind of looks like a wheel. So it just goes around and around over and over again. That's for share acquisition. Another way you can use this is for short to medium term income. Now, in this case, we're not so interested in owning the stock. We just want to continue to generate income. So you start from the same place, cash secured put. Now, in this case, there's an intermediate step. If you get to a 50 to 70% profit, yes, then you close the position, you keep the premium, and you do another cash secured put. You just continue to do this over and over again. And as you saw, the time frame was only 9 days. So you can do this basically every week. You can make 50 to 70% profit every week and just continue to do this over and over again. But what if you haven't made the profit, but it does get assigned? So if it's not assigned, then you continue to do the same thing. Cash secured put, go through the same process. But if it is assigned, now we go to the covered call strategy. Now you pick a covered call with a strike price that's much closer to the price. So in this case, you actually wanted to sell. You're making a profit because in order to get the covered call, the price has to go up, and you're keeping the premium. So you're making money two ways. You're making money as the price goes up, and you're making money on the premium. If the price is not greater than the strike, then you just continue to do covered calls on the same stock over and over again. But in this particular case, so you can generate premium right there. But if it does, it gets called away, then your stock gets sold for a profit, and you keep the premium, and you start back again, do the whole thing over again. So in this particular case, you just want to generate premium. In the first one, you want the stock, so you actually want the stock to be assigned. In this one, you don't really care one way or the other, just that when you get to a 50 to 70%, you just close the position and do it again, over and over again. So that basically, in a nutshell, is what the whole idea of the wheel strategy is. I hope that made sense to everybody. It's a pretty interesting, pretty cool way to do it. If you pick the right stock in the right market, it's something you can continue to do over and over again. There is a risk if the market reverses, especially if it reverses quickly and it goes down. If you're at the initial stage, if you did the cash secured put right here. So remember, a cash secured put, you're selling the option at a particular price. So you're putting a floor on it. So in this case, we sold it at 210. Well, what if this starts dropping and the price continues to drop very quickly? Well, by expiration, you're going to have to buy it at 210, even though the stock might be down to 200 or 195 or something like that. So that is a risk as well. You can always buy the option back, but you'll be buying it back at a higher price if that happens. Just keep that in mind as well. But if you're in the right kind of market, you've got the right kind of stock, it's a stock you want to own anyway. It shouldn't matter if it keeps dropping. So even if you bought the stock at 209 and didn't do any of this, and it started dropping down to 200, you're in the same position. In fact, you probably are going to buy more at 200. Well, in this case, you just do another cash secured put at 200, and you generate income, generate premium, just like you would, 25% of your position, and then another 25, and as it continues to go down, you keep adding to it, but you're adding to it at a cheaper price, at a discounted price. All right, I hope that was clear. Hope that was understandable to everybody. If you're interested, the book on the options page is right here. You can just click on this, takes you right to Amazon, and you can buy it from Amazon. Now I've got 3 books here on the options page, 3 really good books, especially for entry level or just learning about spreads and options and things like that. So that is the wheel strategy. Let me know what you think. Let me know if you have any questions, comments. Please like and subscribe, and we'll talk again tomorrow and see what's happening with the market. Thanks, everyone. Have a nice evening. Take care.